Hey.
Just about that.
Oh, this thing? Yeah. The only thing I'm worried about is like the thing shining in the
If they're sitting down, it shouldn't. Yeah, I don't think it'll be a problem if they're sitting down.
Right, like this?
Yeah.
Okay. Hi, thank you.
Hang out with you all for a few hours, if you don't mind.
Can you interpret a complicated one-page tax plan?
I don't know. What language is it written in? How y'all doing?
Pretty good.
It's nice, nice little room. I think we'll fill it up.
The registrations alone will exceed the seating here, so we'll put maybe people registered.
How many registered?
There were 63 as of Friday morning.
Pretty good.
How are you?
They thought so, but
Did you just want to put one up on each side?
Yeah, like they're
John and
men, so it should work perfectly that way.
So you're ready to moderate or what you agree?
I'm worried about you guys. They're swearing each other.
Such agreement with each other, isn't it?
To confirm, yeah, confirm we have emails.
It's true, it could actually be, yeah.
Okay.
You're gonna
And then I think
all
that was the table that side we can set up with, we have.
talk about.
Yes. I can check and see if there's an extra
Well,
table.
sometimes you gotta stop and just for intellectual honesty, say, it does say in between. But there are,
It's
if
right.
you select the
Yeah, it's really
things
good.
out, okay.
Well,
That's
I
the
mean,
perfect start to discussion. Yeah. Right.
I mean, there's nothing wrong with the 15% rate, I mean, that's good.
Yeah.
But there's a second part to that.
I noticed that
Yeah.
the actual page of the plan does not mention pass-throughs at all.
It doesn't mention expensing.
Well, that I knew they
Right?
didn't mention, because they were befuddled on where they stood.
No, it's a real rookie error because everybody does it at first. They go, I want 15% corporate rate. And then what happens is,
Well, I think that's the most why they say business tax rate.
oh, there,
It's
that's
still-
okay.
It
No,
still leaves
that's
the question, well, it still leaves the question, but they couldn't answer this clearly, is it all pass-throughs? Is it just small business pass-throughs? Is it all pass-throughs minus rich people coming into the shelters, which is basically what we'll prevent that. So anyway,
They say we can go.
that was at the press conference, Nugent said, someone, maybe it was at the Hill thing actually. Nugent was asked how we prevent people from using
I'm super tall guy.
what rules?
Yeah,
A rate differential of that size would have some super serious rules.
no,
So it's not awesome.
but that's okay.
Yeah, can
That's
you show the other one, cause
I take it back, I couldn't figure out how to open it up.
I never noticed this before, but flat tax,
Yeah.
X tax, and even the 2005 proposal,
Oh, where's the,
panel,
where's
the top individual rate was equal to the top.
Yes.
I never, and I always thought that was good. I guess
Yeah, and then we just put the poles fit
Yeah.
together.
Yeah.
Should we move it over? Okay,
It's okay, because if there's somebody that comes in the door, I think they can still.
And you want to show up, but they're not a coast.
Yeah.
Okay.
This is clearly not doing it the right way. You put them in that order. Starting with E tag on it. Yeah, perfect.
Can either be a super easy task moderating or could be a full house.
There's a lot. Sometimes things moderate themselves and sometimes they don't.
One thing you can do if you want to do it yourself, I'm sorry, I wasn't conference call, is, after we make our opening remarks, does anybody want to comment on anybody else's opening remarks, and you might just,
I
might
think,
just take off from there.
I think people are gonna hit the questions, during the opening remarks, so it's just gonna be pretty easy to say.
I'll play around with it. This is what yeah. I think it works like nice on the podium here. But there's the podium mic is gonna work.
Yeah.
This one right here.
Yeah.
Okay, perfect.
They were asking about hand mics for Q&A, but I don't remember any of that.
I tried to say I didn't think that could happen, but then someone from communication said it might, so
Even if it doesn't help I think they should be able to ask questions without a mic.
And then,
But I don't know. The room microphone should pick it up for the live stream.
okay.
I think the rate difference is supposed to be understated, or the underreported problem. So everyone talks about that there are no pay for it. You can always pay for it on the plan. Not yet. Right, this revenue loss under control. I have a 35% comment.
Is that Kyle? Hi, I'm Ellis Duncan. I'm the director of tax program here.
Hi.
Nice to meet you. Thank you so much for coming today.
No problem.
On such short notice.
Thanks for hosting, yeah, last minute thing.
Oh yeah. I think we have everything under control.
his campaign, which is maybe twice as big as,
Hey Marty, how are you?
I have a cold, so I'm just gonna.
Oh, I won't touch you then. I am Kyle Farmer.
Oh, nice to see you, Jeremy Scott.
Hi.
Hi, character. This was you.
How you doing, Kyle? Been busy?
A little.
With the tax reform, or?
Well, everyone wants me to peer into a crystal ball and try to understand what Trump is thinking. I can't do that.
Fool's errand. I think that's, what do I say, it's incoherent and inconsistent, so why should even bother?
Yeah, it's more
Read the tea leaves.
like, at this point, it's a wish list. So obviously, that entire package is unrealistic. He'll only get a part of that, and he'll only get it if he's willing to make some tough decisions.
Yeah.
I don't know if he's willing.
Well, the thing that I think should go by the wayside is expensive. I know it's hard for tax foundation folks.
Yeah.
But
These
you have to folks.
I only have my remarks, so if you have
Yeah,
questions,
so
I
that's
do
one of the
need the
battles we always
questions.
have to make is the difference between
Or one short.
how they view tax policy when it
Yeah,
interacts with
absolutely.
their income statement and how economists view tax policy. So I think.
Don't give him to Marty, he doesn't deserve it.
If anybody has to be sure to.
It's true, that too, yeah.
Something big. And you leave it for small business because it is a help, tremendous help.
Yeah.
Cash flow, and they don't have,
And these are the,
they don't have.
I copied, I have trouble finding it, this is what I
Yeah.
have, this is the actual.
You have the exact same thing I do.
Oh.
I just have one with a tax analyst.
Yes.
Oh, okay, that's okay,
Yeah,
I'll
I
give everybody.
think that's also, one of the reasons they'll drop it is because a lot of people will say, well, maybe you should also get rid of the interest.
Quickly,
Have you ever been to New Zealand? No. You should go. It's actually scary how much they respect it. Really? Yeah. I mean, I actually had to recalibrate because I realized for the first time in my life I was in a place where I actually listened to what I had to say and act on it.
And so you got to be careful, right?
Yeah.
That makes sense. So you got to be careful.
I'll introduce everybody in the order that I introduced you. That's what was in the opening remarks.
Okay.
So starting with Professor Goodberg.
I'm going first? Oh, geez. I didn't know what order I was going.
Microphone's on.
This is scary. I've got to think of what I want to say.
You realize you're on the mic.
Yeah, it's a hot mic. Yeah. Does this one work? Yes. Good morning, everyone. Thank you for joining us. Welcome to the latest installment of Tax Analyst's ongoing conference series on tax reform and tax policy. I'm Jeremy Scott, the Editor-in-Chief of Commentary and Analysis at Tax Analyst, and I'll be the moderator today. By way of background, Tax Analyst is a nonprofit publisher of tax notes, state tax notes international, and other products on tax policy and practice. We've been around for over 40 years. We've been doing 15 years of public discussion on tax policy and practice. If you're new to our events, thank you for coming and welcome. If you're not new, thank you for coming back. Today's discussion is going to focus on the possibility of tax reform, which is something that Congress hasn't accomplished since 1986. The Tax Reform Act of 1986 is more than 30 years old, and a wide variety of stakeholders are clamoring for a second round. In fact, they've been arguing for tax reform for many years, noting that most of our leading trade partners have already taken the plunge, either cutting or reforming their corporate tax systems or reforming individual taxation. What's new is that in the last election, one political party won control of the House of Representatives, the Senate, and the White House. To repeat a tired old cliche, the planets could be aligning for a genuine overhaul of the code. The House leadership, led by Speaker Paul Ryan and House Ways and Means Chair Kevin Brady, have put out a blueprint, The Better Way for Tax Reform. The Senate has been working on corporate integration for years, led by Senate Finance Chair Orrin Hatch, and President Trump has consistently promised massive tax cuts and a broad overhaul of the code. As of last week, we now have a little bit more of an idea of where the administration stands. On Wednesday, Treasury Secretary Steven Mnuchin and National Economic Council Director Gary Cohn presented an outline to the press. While it was short on some details, you could see that the administration was definitely pushing to get this done as quickly as possible. Whether that happens or not, we'll see. Before we get into the details, I'll talk a little bit about how the panel discussion will go today. After my introductory remarks, I will turn it over to our panel of speakers, each of whom will make a short opening statement, and then we'll get into a broad range discussion with perhaps some guided questions, or perhaps the speakers will just react to things that they've already said. Towards the end of today's sessions, we may open it up for audience questions if there are audience questions, and we may also take questions from our online audience. We are recording this event for viewing on the Tax Analyst website, which explains some of the cameras, which this says are built into the ceiling, so Big Brother is watching you. For media purposes, everything said is on the record. For that reason, when we recognize you to speak, if you're asking a question, please tell us who you are and what organization you're with, if that's applicable. In the coming days, we will post a copy of today's event on our website, taxanalyst.org. Be sure to look for that if you want to see the discussion again. Before we go any further, I want to acknowledge the support and help of someone who was instrumental in making today's conference possible. That's Mr. Ellis Duncan, the director of the Graduate Tax Program at Georgetown University Law Center and an adjunct professor of law. I want to thank Ellis and Georgetown Law Center for helping make this possible. I'd also like to thank the communications staff at Tax Analyst who put this on pretty short notice, and someone who is not here, Mr. Robert Golder, who did a lot of the prep work for the conference. He deserves our thanks as well. Now I'll introduce our panelists. To my immediate left is Itai Grinberg, professor of law at Georgetown University Law Center. Seated next to him is Leonard Berman, Institute Fellow with the Urban Institute and co-founder of the Brookings Urban Tax Policy Center. Next is Alan Viard, Resident Scholar with the American Enterprise Institute. Kyle Pomerleau, Director of Federal Projects at the Tax Foundation. And finally, Martin Sullivan, Chief Economist and contributing author with Tax Analysts. Now, on to the subject at hand. Before we get going, I thought it might be helpful to do a brief summary of what was announced last week by the administration. Fortunately, it's very suited for a brief summary. I could actually probably read the entire thing to you, but I won't. We'll just hit some of the high points to sort of give the groundwork for our discussion. So, the administration built on its campaign plan last week and sort of updated some of its provisions. The main things that they did is they promised tax relief for American families. They say especially middle-income families in the summary that they provided. They will reduce the 7 tax brackets to 3 tax brackets of 10, 25, and 35%. They will double the standard deduction. They will provide additional child and dependent care expense relief. They will eliminate targeted tax breaks that mainly benefit the wealthiest taxpayers. No specificity on that, although they do say they will protect the home mortgage interest deduction and the charitable deduction. During the remarks at the press conference, not on the sheet, they sort of went back and forth on what this meant for retirement savings. At first, they indicated that retirement savings might be open to change, and then later they said they would not be touching retirement savings. So I'll let people interpret where we stand on that. The plan would repeal the alternative minimum tax, and it would repeal what they call the death tax, which is also commonly referred to as the estate and gift tax. They would also repeal the 3.8% tax, net investment income tax that was put in as part of healthcare reform. On the business side, they have 4 bullet points: a 15% business tax rate, a territorial system, a one-time tax on trillions of dollars held overseas, and they will eliminate tax breaks for special interests. Again, no specificity on what those special interests are. And with that summary of the plan, I will now turn it over to Professor Grinberg for our first opening remarks.
So thank you, everyone, for being here. Thank you to tax analysts for doing this with Georgetown Law. And thank you to my fellow panelists for agreeing to be here. I'm thrilled to be with such a distinguished group. So in my view, the administration's tax plan is sufficiently unrealistic that it may have overall set tax reform back a bit. I think the baseline assumption in the policy community was that the administration would set aside what the Trump campaign had said about taxes during the course of the campaign and come out with a proposal that, while it might, for example, differ in substantial ways from the House blueprint or from the camp draft, would certainly be forward-leaning. I think everyone expected that. I think the thought was that it could legitimately form the basis for debate, and I would suggest that against that metric, the administration failed. It remains the case, however, that the president has signaled by way of this announcement that he is willing to commit political capital, perhaps significant political capital to tax reform, and that is a very important element of real tax reform in the United States, is real political commitment from the White House. I think the administration will search for a major legislative win somewhere. If, for example, it cannot achieve a health care bill, I think they are likely to pivot to taxes. I think they are likely to learn to engage in a more productive way over time. And so I think the tax reform debate is still in full force. But what is the key underlying fact, the key context in which the tax reform debate takes place? Well, at 77% of GDP, federal debt held by the public is at near record highs outside wartime. Historically, post-World War II, U.S. debt was about 40% of GDP, and if current law remains unchanged, the CBO projects that growing budget deficits would boost the debt sharply over the next 30 years. It would reach 150% of GDP in 2047. That's already an unsustainable level of public debt. So substantially increasing that level of debt is, as Doug Holtz-Eakin has said, sailing straight into a debt crisis is not a pro-growth strategy. That doesn't work. Now, what drives the growth of the fiscal gap? Well, everyone knows this, but it's worth repeating. It's basically the aging of the baby boomers and their rising healthcare costs and expanding federal subsidies for health insurance. And Obamacare is a part of that, but Medicare is much more important. According to CBO's calculations, the aging of the population combined with the absence of activity on entitlement reform accounts for substantially more than half of the projected growth in federal spending for the next generation. So unless we take that on, our policy flexibility for tax cuts is reduced. So how does that play into the tax reform discussion? Well, let's just talk about the corporate tax first. I think that corporate tax reform is one of the things that really drives the debate here. There are a bunch of reasons to think that the corporate tax is inefficient and bad for growth, and that the cost of the tax is increasingly being borne by workers. And we know that the U.S. international tax rules are entirely broken, and there's basically consensus about that. They're badly out of line with developed economy norms, and they're deeply uncompetitive in a way that's causing a variety of problems that people have seen over the course of the last decade. All of those are good reasons why revenue-losing corporate tax reform would be better than revenue-neutral corporate tax reform. But to enact and sustain revenue-losing corporate tax reform in this long-term budgetary environment, we're realistically going to have to find some way to offset that revenue loss. And to explain to the U.S. populace why doing that makes sense, in much the same way that all of Europe, including countries that are historically much less business-oriented than we are, have basically managed to do over the last 25 years. And the case for just pure tax cuts outside the corporate space is simply not as strong. So with that, I'll let other people make their remarks. Thank you, everyone.
Mr. Berman?
Thank you. I'm a little embarrassed. I looked at my notes for this talk, and I realized I just had a page of bullet points that have been thrown together really, really quickly. But then it was okay. I realized that was the president's plan. I've thought about this a little bit more. Okay, so I'm a little bit grumpy. I came to Washington in 1985 to work on the second stage of what became the Tax Reform Act in 1986. Even though President Trump thinks I'm a communist, I actually came to work for Ronald Reagan, and it was one of the best experiences of my life. The president's right about tax reform, that leadership is probably necessary, but it's not sufficient. And in any event, his plan didn't really constitute leadership. I'm pretty sure that Donald Trump wouldn't walk into a real estate negotiation with 1 week of preparation with a skeleton staff that he hadn't bothered to flesh out yet. The political leaders at Treasury who would be leading the effort to do tax reform are not in their positions yet. I don't even think all of them have been nominated. If you compare what Ronald Reagan did with what Donald Trump did, Ronald Reagan gave a speech in January 1984, and he said, I'm going to instruct my Treasury Department to put together a tax reform plan that we're going to release in the fall. And everyone, including me, just laughed like that was the most cynical thing I'd ever heard. Of course, he's going to have a tax reform after the election. And all evidence is that he miscalculated. He thought that Mike Dukakis was going to have a tax reform plan, and he didn't. But Treasury didn't get the memo that this was a joke, and they put together Mondale, whatever, they're all the same. They lose. Okay. I just had this flashback to my young son looking at a penny and asking me whether that was Walter Mondale on it. And I thought, that would be awesome. You know, if you lose the election, your face gets put on a worthless coin. But Mondale didn't even get that. So, I mean, Reagan had his staff working for 10 months. They put together a 3-volume set that started with principles, and then had detailed proposals for a plan that arguably would have advanced all of those principles, and then even talked about, this is amazing, thinking about the religious aversion to this among the current political leadership. There's even, chapter 3 was on value-added tax. They decided not to push it, but the Reagan White House could have a whole volume about why that was something to think about. Donald Trump threw together a list. It's unique in its unseriousness, and it's part of a disturbing trend. And I guess in his defense, there's been a movement away from Reagan-style tax reform. Barack Obama, as far as I can tell, had a fully fleshed out business tax reform plan that his Treasury Department put together, but he just put out a bunch of principles that had detailed revenue estimates associated with them, and then said, I'm going to work with Congress. Well, that's very different from the Reagan model, where he said, you know, I've got an idea, I'm going to put my own prestige on the line for this idea, which gores a lot of oxes and gets into a lot of arcane details, and I'm going to push this. George W. Bush actually empaneled a tax reform panel that produced a couple of amazing options for tax reform, very detailed. After it was all done, one of the co-chairs of that panel came to visit President Bush in the Oval Office, and he starts opening cabinets. And the president says, what are you doing? And he said, well, I'm looking for my tax reform plan because you obviously lost it.
Yes.
And then President Bush said, well, I've got a bunch of principles and I'm going to work with Congress. A serious, carefully specified plan that the president understands, believes in, and will try to sell to the public, like Tax Reform Act of '86 would help. It would also help to have a president that had some political capital to spend, but he might actually bolster his image if he indicated that he was really serious about this. He was going to put in the work, and that he was going to make some hard choices. Cutting taxes for everybody is not a hard choice, unless you think people have grandchildren and care about them and understand the debt dynamics that he talked about, which apparently they're betting against. So what should the goals of the Tax Reform Act of 2018 be? The first thing is enough revenue to pay for the government. If you're not going to touch entitlements, and President Trump has said that he won't, it includes not just Medicare, but Medicaid, which pays for a lot of long-term care for seniors, and other health care, then you're going to need to bring in more revenue. You're not going to be able to even deal with our current budget problems by just cutting non-defense discretionary spending. I have no doubt that the current budget director would do that if he were czar, but that couldn't even pass the House of Representatives. You need to address the concerns of Trump voters and others who are economically vulnerable. President Trump has done a good job of expressing empathy for those people and convincing them that he cares, but the actual proposals would hurt them over the long run. They would bear the burden of rising debt because eventually it would produce, they or their children, it would produce a debt crisis. And a debt crisis in the richest country in the history of the world would be a really, really bad thing, and it'd take a long time to work out. You need to be honest about what the trade-offs are. The magic growth fairy doesn't exist. The problem with our economy is demographics, rising healthcare costs. The tax policy plays a part, but nobody at this table thinks that tax reform could close but a fraction of the gap that would be required to pay for a $5 or $6 trillion tax cut. And a policy that significantly increases the debt would eventually put upward pressure on interest rates, and that would more than undo any positive economic incentive effects. Standard principles of tax reform, neutrality, trying to level the playing field, trying to do something about the corporate taxes Ty talked about, trying to take taxes out of people's and businesses' decisions about how to organize their affairs, what to produce, what they should do, how they should do it, where they should do it. Those are all good things. And those are things that Paul Ryan and the House GOP has given a lot of thought to. Senator Hatch, too, I think, has been working on this. But it'd be good if President Trump would, one, get his tax team in place, second, talk to the people in Congress, and then say he'll come back in about a year after he and his staff have had time to think about how they could advance this. Because tax reform is hard. Who knew?
Alan?
Thanks. So I outlined some of my views of what I expected to be in the tax proposal in an op-ed for thehill.com last Wednesday morning. I argued there, and I've long thought that getting the corporate rate down to 15% would be highly desirable. The corporate income tax is riddled with distortions, particularly in the globalized economy that we now have, and getting the rate all the way down to 15 would be an excellent way to really reduce those distortions in one fell swoop. But as I cautioned in the op-ed, the concern raised by that, of course, is the substantial revenue loss that you would incur with that rate cut, even allowing for revenue feedback from increased economic activity. And yes, I do agree that a debt crisis is not a good pro-growth strategy, and so I think that we probably should try to offset that revenue loss. I did discuss in the op-ed a couple ways that could be done. One is by increasing taxes on shareholders, as Eric Toder and I proposed, and the other would be part of a package that would introduce a value-added tax. There are other ways that could be pursued as well, I think. But of course, I expected, and we all soon learned, that the Trump administration was not going to propose those types of revenue offsets, or really any significant revenue offsets that would be commensurate with the tax cuts that they're proposing. There's been a concern that this might be a tax cut for high-income households and not for other households. Clearly, it is a substantial tax cut for high-income households when you look at the individual changes and at the estate and gift tax repeal and at the corporate tax rate reduction and the lower rate on pass-through business income. Yes, it certainly gives a large tax cut to high-income households. I do think, though, that between the doubling of the standard deduction and the changes that will probably be made in where those rate brackets start and stop, that we actually will also see a tax cut for middle-income and lower-income households as well. Once you decide not to worry about the deficit, there is no reason you can't give everybody a tax cut, and I think that's what we would expect to see here. I don't believe that a package with this large of revenue loss actually can be passed, and I think we maybe can take some comfort in that. Nevertheless, putting out a proposal like this with such a large revenue loss while downplaying either the existence or the significance of the revenue loss, I think still has to harm the debate in very significant ways. It really further downplays the significance of the deficit. I think it actually weakens any push that could be made, not just for revenue increases, but also for entitlement restraint. Of course, the president has already said that he's actually not interested in entitlement restraint. So I do think that this proposal has probably affected the debate adversely in at least some important respects.
Kyle?
Yeah, so I definitely wasn't expecting a plan that was less detailed than the previous one. Now, I remember back September 2015 was actually when Donald Trump, the candidate, released his first tax plan, and now that was a rough outline. That was a campaign proposal, but
four pages.
But it was 4 pages, and it had enough detail that two of the groups that model tax plans were able to look at the details and say, yes, we think that this is going to cut taxes by about $10 to $12 trillion over a decade. And to his credit, candidate Trump, after realizing that the plan was a very large tax cut, went back to the drawing board, presumably, and added additional detail, changed things around to move it closer to the GOP plan, brought down the cost to about $6 trillion, so cut it in half. Pretty good there. So that's why I was expecting this next time around that he would add on to that work that he had started during the campaign to get a plan that was even more detailed and maybe even closer to what the GOP were proposing. But alas, he put out something that I think was a couple steps backwards in terms of detail and couple steps away from what the House GOP is attempting to do. Now, policy-wise, I think there are a few good things in the plan. Agreeing with Alan, the lower corporate tax rate is good. Eliminating the alternative minimum tax, eliminating the estate tax, reducing marginal rates in general across the board, reduces a lot of bad economic incentives in the tax code. But I do have some concerns about the plan. Again, one, it still looks like, even though we don't have details such as bracket widths for the individual income tax, it's really hard to tell exactly how much this is going to lose in revenue. But just looking at it, you can tell, because it's basically all tax cuts except for one base broadener, which is basically the state and local tax deduction elimination. I think that's problematic, one, because if it's going to be a tax cut, it's likely going to be temporary. And permanence is an important principle in tax policy. Businesses that make investments over the long term would rather see their tax situation stay constant over time, individuals the same. And if you put through something that's simply going to cut taxes, it's very likely it's only going to last for 10 years. To echo what others have said, we're not in the same fiscal position as we were back in 2001 when we were projecting surpluses, and that the last time we did a tax cut. Now we're projecting deficits that are going to climb close to $1 trillion annually. Probably not a good idea to add another 300 to 500 billion annually to that. The argument that it will pay for itself, I'm very skeptical. I think that the cuts will create some dynamic feedback, but certainly not even close enough to approach paying for itself. You're still going to have a deficit. It's still going to be a sustained deficit over time. Now, I think politically this creates a challenge. This is my last point. And I mentioned this earlier. I think it's creating a larger gulf between the House GOP plan and the Trump plan, and that's, I think, probably not very good for the prospects of tax reform, because the GOP plan is already facing some political pressure to take some of its base broadeners out of the plan, and now Trump has basically put out a tax plan that is similar to the GOP proposal, except with no base broadeners at all, except for the state and local tax deduction. So I think it's going to make just a straight tax cut more politically attractive for some, and I think that may end up being a bad thing.
Marty?
Thank you, Jeremy, and thanks to Georgetown and the tax analyst staff for putting this meeting together at such short notice. It's an honor to be on the panel with such prestigious folks. And as expected, they've said everything that I would have said.
You got the worst spot.
At the number 5 spot here. So I'm going to take a little different tact and talk about where we've been, and maybe that'll give us some insight about where we're going. And Reagan-style tax reform that broadened the income base and lowered the rates was embodied in Dave Camp's 2014 tax reform. And that went nowhere because of the impossibility of reconciling hope for rate reduction with politically viable revenue raisers. So that was Plan A. Now, forced to think outside of the box, House Republicans boldly proposed a destination-based cash flow tax. That's Plan B. And the economic and competitive advantages of this tax are potentially enormous. They're far greater than the 1986 Act. They're far greater than even the plan suggested in the Trump outline. Right now, multinationals are discouraged from investing in the U.S. versus Ireland because there's a 26-point tax rate differential, disadvantage for investing in the United States. And under the Trump plan, as outlined, that disadvantage would be reduced to about 7 points. But under the blueprint, because location decisions would not be based on the location of production, the disadvantage would change to an advantage of 12.5 percentage points. So under the blueprint, the United States would become a tax haven for job-creating real investment, which is, I think, our ultimate, goal. Unfortunately, in addition to the normal political problems of any tax reform, the technical and administrative problems of Plan B are forbidding, and I'll just list a few. Number one, almost certain violation of WTO rules and consequent uncertainty about the trade war. Number two, extreme difficulty in defining exports and imports, especially in cross-border exchange of business services. Number three, extreme difficulty in determining the proper treatment of financial institutions. Number four, extreme difficulty in distinguishing high tax wages from low tax profit and pass-throughs, which I think we're going to talk about some more. Number five, impossibility of collecting import tax on foreign business sales directly to U.S. customers. Number six, absence of refunds for exporters in a permanent loss position. Number seven, uncertainty about the size and timing of exchange rate adjustments. Number eight, a multi-trillion wealth transfer to foreigners if the dollar appreciates, and Alan's talked about this a lot. Number nine, if the dollar appreciates, the potential financial instability arising from the strain on less developed countries with dollar-denominated debt. And to make it an even 10, although there are many more, an almost certain constitutional challenge to the destination-based cash flow tax because it may violate the 16th Amendment. So with all of this, not to mention the absence of a strong presidential endorsement and lukewarm support in Congress, I'd say the blueprint is on the ropes and its last gasps before its disappearance. So what is Plan C? Perhaps it will have the contours of the Trump outline. I have a list of possibilities here, but I want to take up any more time. Perhaps we'll get to them later. And thank you for the time here today.
Thank you. So we have a couple of questions that I wanted to get to, but actually I know we had discussed talking about some aspects in a particular order, but I wanted to get back on a point that was made by some of the panelists that the plan put out by Trump last week has actually set tax reform back. And just to frame a little bit, given that tax reform wasn't making that much progress in Congress over the first few months of the administration to begin with, given that the House blueprint had consumed a lot of the oxygen in the room but wasn't picking up Senate support or really even support outside the Ways and Means Committee, couldn't it be argued that just by putting out a broad set of principles, Trump has advanced tax reform just a little bit, just by putting presidential capital behind it? I sort of want people to kind of explain why you think this sets it back, given where it was before April 26th. So, Len?
The big problem is that he vastly overpromised and just set the expectation that, a 15% tax rate on businesses, you're going to cut taxes on individuals, you're going to do $5 or $6 trillion worth of tax cuts without specifying, aside from the state and local tax, anything in particular that would offset the revenue loss, and implying that between economic growth and somehow these painless base broadeners, that it would be easy to make the numbers add up. I mean, what the president should be doing is explaining, one, that tax reform is worth doing, and two, that there are trade-offs. Not everyone's going to have lower taxes, and there's no magic that makes it hard to deal with, makes all the politically challenging things go away.
Yeah, I do want to stress that the mere fact that the president released general principles instead of details in and of itself doesn't set the tax reform debate back. I mean, it would be great, of course, to have more detail than this very general, very vague outline. But I think that's not the source of the harm. Instead, it's what Lynn said. I mean, creating the expectation that the hard choices can be avoided, that there's a free lunch here. So it's really the content of what was put out, not the lack of detail.
I mean, just to say it another way, tax reform is actually about picking like the least bad looking horse in like the glue factory I mean, that's tax reform, and you have to inspect all the horses. And I think there are people in Congress, both the leadership of the tax writing committees and their senior staffers who have engaged in that inspection. And I think that there was an expectation in the policy community that the first thing the administration said would have suggested that they kind of looked around the glue house or the glue factory, and instead it looks like they, said there's a magic unicorn, and there's not a magic unicorn.
Kyle?
Yes, I think there's an important distinction between tax cuts and tax reform. I mean, what I think he's putting out is something, even though there's no detail, he's just basically setting the revenue levels for the government based on a set of principles, whereas tax reform is harder. It's you're defining a tax base that you want and then setting your rates in order to raise the amount of revenue you want. So I think the reason I think it might be a step back is it's, again, the details in the plan rather than the fact that it was didn't have as many details as we'd like.
Do you want to say that, Marty?
I only think it's a step back if you had expectations that things would move forward.
Yeah, we had expectations. It sounds like the panel had expectations.
I was but what is very notable about is what is not on that single sheet, which is there's no mention of expensing, there's no mention of limiting interest deduction, and most importantly, there's no mention of border tax adjustments.
Yeah.
And I imagine Paul Ryan and Mr. Brady are very disappointed by that because it wasn't, he did not speak against them, but he did not speak for them. And I think if you're looking, now you're looking at two divergent paths. I mean, these two plans cannot be reconciled, the House Republican plan and the President's path. I don't mean, they say there's 80% overlap, but there's not. They're going in very different directions. And so I don't know what's the inside politics of what's going on, but you can see from the outside that they are not in agreement at all.
Yeah, let's actually talk a little bit about that. And Marty just made the point. He doesn't think that the House blueprint, that the destination-based cash flow tax can be melded with this plan. What do other panelists think? Do you think that the cash flow tax is now dead, or do you think that there is a way to sort of reconcile these principles that Trump has put out with some semblance of what's in the House blueprint? Because certainly that's what they say is happening, that they are working on refining the cash flow tax, refining the blueprint to make it, to get from that 80% to 100%. So what do people think? Do you agree with Marty? Anyone?
I'm happy to.
No, go ahead.
No,
Yeah,
go.
I went first last time.
Okay, fine. Alan, Kyle?
Well, but let me just say a word. I think that we know that the cash flow tax, destination-based cash flow tax, had run into severe problems, clearly problems that the House Republicans did not anticipate when they first proposed it. I would interpret its absence here as a further confirmation that it's not likely to be part of any tax bill that is passed this year. I think it has been a valuable learning experience, however. It's obviously the idea of a border adjustment is not in and of itself particularly unique or novel, because after all, 160 countries have border-adjusted value-added taxes. But I think that what the Republicans have learned and what the tax community has learned is that attempting to do the border adjustment with a cash flow tax, that is, with a value-added tax that allows a wage deduction, rather than with a conventional value-added tax, raises a host of problems. And Marty actually outlined them quite well with his list of 10 points there. And if you go through Marty's 10 points, nearly all of those problems go away if you do it in the context of a value-added tax.
And you retain the same benefits as well.
Indeed you do. And so I think that may be the moral here. I don't believe that we have seen the last of the border adjustment, but I believe that when it returns, it will be in the form of a border-adjusted VAT. I don't know when that will happen, but I think that is probably the takeaway from the debate we've had over the last year about border adjustments.
Right. So, I mean, I do think it's a question of when rather than whether we move towards a destination-based consumption tax of one form or another, given the mobility of all other factors, so capital, corporate headquarters, plant and equipment, high-skilled labor, the difficulty of taxing local factors in a global economy. We will move towards a regime based on destination eventually, unless the free trade architecture falls apart first, which would be a tragedy. Moreover, I think that it's not just the United States. I think other countries are likely to look at DVCFTs over time too. So, if the EU manages to build a true hard line against a reasonable Brexit deal, I expect the UK may take a serious look at the DVCFT to replace their current corporate income tax. And in any case, by cutting corporate income taxes, raising VATs, and raising wages, countries around the world are incrementally moving in the direction of a destination-based cash flow tax like the House Blueprint every year. So I don't think the House Blueprint is dead. I disagree. I think that tax reform is an exercise in picking the least bad-looking horse in the glue factory. I think people like George Callas in the House, Mark Prater in the Senate, have done a good job of inspecting the horses. I don't think other people I think what the administration shows other people of influence haven't done that. Until there is widespread understanding of the trade-offs involved in all the viable options, no viable option is dead. That's just reality, right? Rather, there are going to be multiple moments where, to paraphrase Mark Twain, reports of the death of one particular approach are greatly exaggerated. That's where we are, because we just haven't gone that far down the road. Border adjustments are meant to reach the destination principle. The destination principle is the right idea in a truly globalized economy. Everyone's moving towards a DBCFT. They just do it in 2 taxes. We're doing it as 1 tax. That's our own political stupid. So be it. But I actually think that, I actually don't agree with all of Marty's 10 points either. I actually think, as someone who used to think that it's not WTO compatible, I now believe that it can be made WTO compatible. I've put that out there. I think that you have to go at it a particular way, but you can do it. I think that a lot of the problems that Marty describes also exist in a VAT. Certainly a VAT that replaces the corporate tax, because it's difficult to deal with financial institutions if you think that financial institutions need to be taxed and you need a tax system to tax them. I mean that problem just arises, right? So the answer in the VAT is, well, we just mostly give up on that, and then we have an income tax and then some financial institutions tax. B2C can be solved. It requires treating, payment processors as tax intermediaries, but it can be solved. The absence of refunds. I think any serious DBCFT system has to treat losses as tradable. That's the whole point of the system. You have to get people to understand why that's true. And people on this panel start shaking their heads because they know that on an income tax, no one believes that. But every VAT believes that, and that's how it has to be. And if you don't do that, you end up with senseless transactions in which, as the joke is, you end up with Boeing Walmart, right? Like Boeing and Walmart merge. This is a problem. So you have to accept the logic of the system. But a lot of these problems exist in the VAT too. The exception, I think, is that in the appreciation space, the labor reduction makes the appreciation bigger. So,
yeah. So there are a couple of issues with the border adjustment tax as a model. I think that the advantages of a location-neutral tax system and the efficiency advantages of exempting the normal return on capital makes perfect sense. I think there are distributional issues, which will be a political challenge. There are 2 problems. One is putting in place a 20% VAT or destination-based cash flow tax right away, especially in the biggest country in the world, I think would be really disruptive, and there would be transition issues. And politics isn't argued in the long run. It's argued in the short run. And in the short run, importers would have challenges either with a 20% DBCFT or a 20% VAT. What you could do is you could phase in a VAT over time. The second thing is, and several panelists have talked about this, the wage deduction is kind of the original sin. And I think politically explaining to people why Boeing either should get a giant refundable tax credit for its wages or be able to sell its deductions for millions or billions of dollars when it's making huge profits, that's going to be really, really hard to explain to real people. And the people who are, the Democrats aren't going to want to help make this clear. So it would make a lot more sense to phase in a value-added tax, which has the destination basis as well as a replacement for the corporate tax, and to put the wage subsidy on the individual level, which has the additional advantage of arguably addressing the challenges of those low-skilled Trump voters and other people are feeling very vulnerable in the modern economy, that they'd get a boost to their wages. And it would be more apparent what the distributional effects were than allowing companies big deductions for wages over and above their actual tax liability in the case of exporters.
Yeah, I mean, the clear question is whether we can get far enough in the debate that people on both sides of the aisle are prepared to think about a VAT, whether it basically remains a non-starter or not.
I think Ty is right that, a lot of the things that you need in the destination-based cash flow tax are just things that are already present in a VAT, and that if people understood the economic logic, then they would be fine with things like exporter refunds. And so like many people, I keep hoping that economic logic will be understood. But I think at some point,
What's going to happen when the magic unicorn?
yeah, I mean, at some point, though, I think you just have to face the question, like, if you need to have these features, and if people understand their role within a VAT, but you can't really make people understand their corresponding role in a cash flow tax, then maybe the VAT, really is going to turn out to be the easier path to getting those things done.
When you try to explain a VAT to voters, aren't you essentially, voters don't care about wage deductions, they don't care about the economic boost. What they're going to see is higher prices. Like, what political party is going to spend the political capital to go out to voters and say, yes, you're going to pay 5, 10, 15, 20% more for every good, but trust me, this is better for the overall economy? Like, isn't that going to be an extremely difficult sell in a mature economy like the United States?
My answer would be that the VAT is never going to be adopted because people are, enthusiastic and clamoring, for it to be introduced. It's going to arise, I would imagine, as a bipartisan agreement when it comes to be seen as better than the alternatives. I think it goes back to Ty's point about you have to compare, what the alternatives are out there. As the fiscal imbalance, continues to progress, there will come a time when Republicans, Democrats have to face a choice between raising income taxes, introducing a VAT, or cutting entitlement spending. I believe that the VAT will probably be both parties' second choice, and so it may seem in the end that a compromise accepting that is better, and it will avoid the income tax increases that Republicans would be staunchly against, and it would avoid the deep entitlement cuts that Democrats would be against.
Yeah, look, dealing with fiscal problems takes meaningful leadership. Leadership of a kind that has been in short supply in the United States. One way to think about it is 3 successive Australian governments basically fell over trying to figure out a fiscal problem and ending up with a pretty decent VAT. 3 successive Australian governments were willing to do that. There was leadership.
Well, the reason that other countries have VATs is not because they favor regressive taxation or price increases. It's because they want services from government, and they want an efficient tax system to raise the revenues. We've been insulated some because we actually have a smaller public sector, and our revenue needs have been less extreme, but with the aging of the baby boomers, rising healthcare costs, and especially if we can't make dramatic cuts in entitlement spending, we're going to need to raise more revenues in a way that doesn't impose a huge drag on the economy. The logic will be exactly the same as what it is in other countries. That people want the services, and you want to raise the money in a way that doesn't wreck the economy.
Kyle?
Yeah, the political issue of how are you going to sell a price increase, that's very tough. And the workaround is, the DBCFT. It's very unlikely that tax would result in a price increase in the broader economy. So I think that direction where in European countries have been doing this, moving away from, your origin-based taxes, cutting your payroll tax, cutting your corporate tax, raising the value-added tax. I mean, that's a swap that other countries have done. And I think that may be the future here. And that's, again, tying this all back. I think I agree that that's why this approach isn't dead at the end of the day.
Did you want to say something about this, Marty?
No. Except I would say that Itai's articles on the value-added tax are outstanding, and I recommend them to everybody. I think he's making the right points. I wasn't. I think when you talk about making the DBCFT work, you're sort of making it more like a value-added. You're sort of even more making it like a credit invoice VAT, and so without actually calling it that, and that's good. We can get away with that, but great. I recommend those articles very highly.
Sort of building on a point that Alan just made, that when it comes time to look at a VAT, it's probably a moment of great fiscal crisis, and it's going to be our least. It's going to be the least of the evils, or whatever, the less ugly horse. I can't quite remember your analogy, but since I think there's probably broad agreement, we're not quite there yet in terms of this crisis, and instead we're still debating whether we even need tax reform or whether what we're talking about is a tax cut. And so let's talk a little bit about that and the revenue neutrality issue. Given that the administration has now committed to a tax cut and moved a little bit away from what we would understand as 1986 style reform, and has definitely moved away from something that is even nominally revenue neutral, do we think that a revenue neutral tax reform package is now off the table, and that Republicans are going to be pressed now to deliver at least some semblance of a tax cut, maybe not quite this large, but is that now the direction that we're moving, at least in the near term before the midterm elections? Marty?
Well, I think the path of least resistance, we're not going to get a VAT. So the path of least resistance is to do a tax cut, because we passed the burden to future generations who are not voting. I think there's a lot of different definitions of revenue neutrality. I think 10 years ago there was only one definition. We all understood what that was. But now with dynamic scoring and moving baselines, and I could explain what they all are, especially this peculiar notion from the administration that let's assume a 3% growth rate and work backwards, being one example. I think again, the path of least resistance is to claim deficit neutrality under a very broad and expanded definition, which will actually be a significant tax cut.
Is that a claim that the JCT score will at some point be disregarded in the process, however it happens to be reached? Is that what you just suggested?
Yes. Is my understanding, well, first of all, the Len, you might remember this. Do you remember there was a suggestion during the great capital gains debates of 1991 that the joint committee and not the joint committee staff actually do the estimate of the, because the joint committee, there actually is 10 members of Congress who are the joint committee, but it's always the joint committee staff that actually does the estimates. And so since the joint committee staff had said there was a negative effect, one proposal was to have the members themselves do the estimates. I understand that every time people talk about budget rules and budgeting, I get very scared because they're very hard to understand. But my understanding is that the budget committees can disregard the CBO and pick out their own numbers. And so I think if push came to shove, they could do something like that. It would be easy politically to do, because what you would say is, hey, we think this is we're going to have tremendous growth, and we're willing to bet on that, and these pointy-head economists don't know what they're talking about, and that's what we're going to do. So I think
they can
could.
also direct CBO or JCT to make assumptions for the legislation. I think they did that with some healthcare provisions, or when Ryan, I guess, asked CBO to score his health plan, he he said, well, assume this.
Yes.
And CBO actually got a lot of grief for actually doing what they were told to do. Now, I want to play the Pollyanna just for a moment, and then I'll go back on it. But that Ryan and Chairman Brady have both been very consistent in saying that they want a plan that is revenue neutral with dynamic scoring, and certainly the implication is dynamic scoring will be done by the Joint Committee on Taxation under their ordinary procedures. And I think part of the reason why there is not legislative language from House GOP is because they're trying to figure out how to do that in a politically acceptable way. But I think we should cheer them on and say that this is, as a minimum, that this should be the principle. But it is going to be hard. Revenue neutral tax reform has winners and losers.
Yeah.
And there will be a lot of pressure with a Republican president, Republican Congress to repeal the estate tax and cut tax rates. And at the end of the day, that might be what they end up doing. It'll look kind of like the 2001 legislation. It'll be crafted in a way that it doesn't fall afoul of the Byrd Rule, which means it'll have to expire at the end of 10 years. But that could still be a challenge with their business tax cuts, as JCT pointed out last week, I think. But I'm hoping that another option would be to try to come up with a bipartisan agreement where they could make the case for offsets that would make the revenue numbers really, really work. But it is not going to be easy.
If the Democrats keep making the tax return issue a condition for working on this, isn't that going to push the Republicans to not look for a bipartisan solution? I mean, what are the chances that we're going to see something bipartisan at this point, given the climate?
Ways and Means could get the tax return if they decide they want it. The president doesn't have to agree on that. It's going to be hard, and the Democrats have got, the Democrats might care about tax reform, but they also would like to win back the House in 2018, and presumably it's really too bad that this is the way it is, and it's certainly true for both parties, but that the prime goal is beating the other guys and not necessarily advancing the best policy. And it could be that some president could get beyond that and actually go to the American public and say, you need to make your legislators on both sides make good public policy the first priority. I'm not optimistic.
It's probably not this president.
Yeah, probably not.
Well, just to demonstrate the low probability of bipartisanship, look at this. Look at the estate tax. I mean, will the Republicans cede on that point? And when the Democrats are looking to increase the estate tax, I just think you said Pollyannish. I think it may be. I don't mean to be pessimistic, but I just don't see any way in the foreseeable future that there's bipartisan tax reform.
Another really remote possibility is that the president himself would just change course. I mean, the one interesting feature of this president is that he's willing to take positions that are diametrically opposed to the ones he had yesterday all the time. And maybe if we could get Fox News to run a segment on how the debt is a problem.
He could become a deficit hog. Does anyone else have anything to sort of say about revenue neutrality? I mean, it feels like we're moving away from tax reform and more toward a tax cut.
Well, just to give the audience who's not familiar with it, remember that Dave Camp, without dynamic scoring, barely got to 25% on corporate, and that really wasn't realistic because of the revenue raisers he had in there. So let's say 27 or 28. And on the individual side, he barely got to 35. And with JCT dynamic scoring, I don't think you're going to, I think, Itai, that's what they don't really have large dynamic effects like the tax foundation does. So it's not going to appreciably change the political situation.
It makes a difference, but it doesn't make
right.
no
So maybe
difference.
we could get to 25 and maybe we could get to 35 so that's what we're talking about if we're talking about real revenue neutrality. And there are no other revenue raisers. It's one difference between now and 1986 is that in 1986 we had more loopholes and more preferences. The biggest one, the easiest one to remember, is the investment tax credit. Ronald Reagan said he was going to get rid of the investment tax credit. which is, that's a Nixon in China type of situation, where when you had a president step out and be willing to make that type of sacrifice, that's when we have movement. We don't have anything like that now, any obvious revenue raisers. So as much as in theory we like to broaden the base, we've tried that, and I don't know where there are any other politically acceptable base broadeners.
Well, I think politically it's always difficult, but in the Camp proposal, I think is a different set of constraints as well. They basically said, okay, it's going to be distributionally neutral, revenue neutral, and it's going to be pro-growth. I mean, the House GOP blueprint is moving away from that model. They're not afraid of changing the distribution of the burden. And I think if you look outside of the traditional income tax, Haig-Simon's income tax, there are base broadeners, but I think, again, it requires going back into this value-added tax debate again. And that's why I think the blueprint, or at least the business side, is attractive. They're looking at different ways to raise revenue, and one of the attractive base broadeners there is limiting the interest deduction, which is something I don't think the Camp proposal would have touched. I mean, It's not consistent with an income tax.
Let's talk a little bit about the 15% rate that Trump put out and what this would mean for the corporate tax system. We sort of had talked about how the destination-based cash flow tax might turn the United States into something of a tax haven, or at least make it more attractive for investment, or encouraging investment to stay at home, I guess is a more accurate description. What about this 15% rate? Would this transform the United States? Would this transform the corporate tax system if we could get it down to 15? Would this change the dynamics of the debate around U.S. competitiveness, or is it a little too superficial to actually accomplish those goals?
I mean, I think it would certainly have profound implications. I mean, with other developed countries having rates that are in the low 20s in many cases, I mean, catapulting from 35 to 15 or from 39 to 19 if you include state corporate income taxes, would have to be a dramatic change. It would alter the incentives on where to locate investment, where to book profits, and where to charter corporations. So, yeah, it would be absolutely, I think, profound consequences. It would, I mean, as Marty has indicated, I think be in some ways less profound than under the House blueprint, because the House blueprint actually reduces the corporate income tax rate to 0%, and then introduces a 20% destination-based cash flow tax, or a 20% value-added tax with a wage deduction. So obviously, going from 35 to 15 is not as dramatic as going from 35 to 0, but it would nevertheless be I think a game changer.
Yeah, I mean, the DVCFT is the only proposal that creates incentives to, for example, redomicile out of foreign countries and into the United States, to strip other countries' bases and bring income into the United States. It is the only proposal that does that, right? This proposal gets you to, 15, really 19% corporate rate. I'm a fan of that. For the simple reason that I think it will be good for economic opportunity for future American generations of workers. And in contrast, I think keeping, our current system will over time shrink those opportunities. But, even post BEPS, we do effectively have something approximating maybe like a 5% traditional corporate income tax that exists out there in the world. That's very rough. Right? But that's only if the United States itself then chooses to engage in base protection along the lines of BEPS. Otherwise, you still have an incentive to strip the U.S. base to a zero rate jurisdiction to get out of 19%, which is not as big as 39%, but is still big. And so, this is another reason that what Marty calls Plan B, the DVCFT, ends up looking attractive. You have to do something to protect the base if you're not going to go down the road of a destination basis proposal, right? If you're not,
you're saying the 15% rate alone does not protect the base. Like this 15% rate alone is not going to stop aggressive transfer pricing. It's not going to stop inversion.
It decreases the incentive to strip the U.S. base, but it doesn't eliminate it, and you might still be able to find real money by stripping the base.
You look at what happened in '86 when we cut our corporate tax rate from 46% to 34%. That gave us a low tax rate relative to our competitors, and what they did was they lowered their tax rates. And the same thing would happen if we cut our corporate tax rate to 15%. Obviously, the zeros won't lower it, I don't think. But, Ireland is probably would lower their rate from 12% to something lower. England and France and Germany and those countries. The other concern about the lower corporate tax rate, and probably good for people at Georgetown Law School, is that it creates a lot of tax sheltering opportunities.
Yes.
And if there's a 15% corporate tax rate and the top individual tax rate's 35% or higher, because you probably need a higher rate to meet the revenue target, there's a huge incentive to shelter income in a corporation. And I've talked to smart lawyers who think that there are ways that you can prevent that kind of gaming. But I've also talked, there was actually a fascinating panel that Tax Policy Center had many, many years ago where Joe Bankman, the academic, and Mike Schleyer, the practitioner, were talking about lowering or eliminating taxes on capital income. And Bankman, the academic, said, no problem. We can write rock-solid rules that prevent, major shifting of basically wage income into business into business income. And Schleyer, the practitioner, said, no, you can't. I can drive a truck through any set of rules you can come up with, and that's a big challenge.
Yeah, it is a real challenge. It's why one needs, at minimum, a very serious process that is technically sophisticated in order to think through how this stuff works and try to create a set of rules where there are margins where people can game them, the rules are at least reasonably durable. I'm not claiming there's any rule that will always beat Mike Schleyer, but,
Durable and adaptable.
Right.
You've got to be able to respond when people come up with new ways to take advantage of rules you create.
The lower rate would fix a lot of problems. I think it would grow the economy. But simply cutting a tax rate just reduces the problems. It doesn't eliminate the problems with a tax. So you're still going to have your base erosion provisions because Trump, again, has not decided to go along with the border adjustment and eliminating the net interest expense deduction. And also, I think it doesn't fix one of the big issues with disincentive to investment. He's not going to full expensing of capital investment. And I mean, if you're looking to create a more pro-growth plan, you'd probably want to spend your limited budget constraint. Well, maybe he doesn't feel like he has a budget constraint, but you would want to spend the money you have on things that eliminate your marginal tax rate. So going to full expensing, if you had the money, rather than reducing the rate significantly, would probably be better. I mean, I think a more pro-growth plan may be something where the rate is 15 or 20%, and you go to full expensing at the same time.
Just politically, there are also challenges too. Lily Batchelder did the survey where she talked to finance officers and corporations and said, what do you think about expensing versus cutting the tax rate? And universally, they wanted to cut the tax rate. So all the economists explained, no, that's, if you had expensing, you could even increase the tax rate and it wouldn't matter because you're not taxing the normal return. They go, right, we're going to lower tax rate. The other thing is that if you look at the polls, most Americans think that businesses aren't paying enough.
Yeah.
Right.
And whether or not that's true, it's going to be a political challenge for would-be reformers who want to significantly cut business taxation.
Well, I think that kind of brings us, skipping ahead on the questions, to sort of this, is that why you have to pair this type of business tax reform with an individual tax reform? Like you can't get away with a plan that lowers the corporate rate from 35 to 15 without providing something for individuals. And did Trump provide enough in this outline, or is this outline sufficient to get individuals to...
Yeah.
Can the Republicans, can Congress provide enough for individuals to pair with such a substantial tax cut to give it the political support it needs to survive? Because as you said, if you look at polls, the voters don't feel the need for this massive corporate rate cut, but if you talk to lawmakers, economists, people looking for problems with the tax code, they go right to the corporate rate. So is there enough in this for individuals to buy into it or not? I mean,
I think it comes down to what you're willing to trade off. I mean, the Republicans have already started conceding that they're going to need to do individual reform and business reform at the same time, and not just for individuals, but for pass-through entities. I think pass-through businesses have been successful in getting their thing into both the GOP proposal and the Trump proposal, their special lower rate on their income. Now, that does quiet them down and make it more politically possible to do overall tax reform, but it comes with significant trade-offs that I don't think is worthwhile. I think there comes with a lot of base erosion concerns, not internationally, but domestically, where wages and profits are shifting to this special lower rate, and I think the additional revenue cost isn't necessarily worth it. But I think politically they're already starting to do that, and I think for individuals in the blueprint at least, it's not a significant tax cut; it's more of a tax simplification, and I think Trump, that's where he spends a lot of his revenue is on the individual side. I mean, we don't know now because we don't have bracket widths or any specifics on the personal exemption, but my sense is that a lot of the revenue loss is going to be there.
Alan, why don't you talk about your proposal
Well,
with Eric?
Well, so I think, I was going to say that it is a real dilemma in trying to design the corporate reduction that I think the economy needs in an environment where there is no grassroots public support for that step. And I mean, again, I guess maybe that's the point of a leadership being needed to echo Atai's point earlier. But obviously, one of the things that I think economists and the tax policy community should do is try to communicate, to the public why the corporate reduction is necessary. But obviously, that's a difficult and long-term task. So yes, one possible strategy is to say, well, if we're going to do the corporate tax cut, then we also need to do individual tax cuts to balance it out. But obviously, that brings us back to the deficit neutrality point. I mean, that is a path for a large increase in debt. So what is the politically viable way of dealing with this? Well, I do think in the long run there may well be a package that involves a value-added tax and or some other type of destination-based tax, perhaps, and that would, just be, again, part of a bipartisan compromise that both parties would be willing to sell to the public. But I think there is another path, which is the one that Eric Toder at the Urban Institute and I have developed. We have a proposal that would lower the corporate rate, as it happens, to 15%, the same rate as in the Trump plan. But our plan is deficit neutral and actually distributionally neutral as well. And it does make changes on the individual side, but it's not giving cuts there. Instead, it's increases, but on a particular group of individuals, namely the shareholders who own the corporations. And so it says, let's keep the overall tax burden on corporate income roughly the same, but we will lower the burden at the corporate level from 35 to 15. At the individual level, we'll start taxing dividends and capital gains at ordinary income rates. And moreover, and this is the most controversial part of the plan, I think, is to tax the capital gains each year as they accrue, or to deduct the capital losses as they accrue when that happens to be applicable. Obviously a controversial proposal, but I think it has a lot of advantages. It's able to deliver a reduction in the distortions of the corporate income tax while still maintaining the tax burden on corporate income, and therefore I think, potentially responding to the concerns that people have in that area. Just as a closing note, why does moving the tax burden from corporations from the corporate level to the shareholder level actually reduce those distortions? The key is the margins that are being taxed. Under the corporate income tax, the tax can be avoided by moving investment out of the United States or booking profits out of the United States or by moving corporate charters out of the United States. In contrast, the shareholder tax would be imposed on the capital gains and dividends of Americans who own shares in publicly traded companies. And so the tax would not depend on where the investment by the company occurs or where its profits are being booked or where it's chartered. So none of those distortions would be present. The tax could not be avoided by moving any of those activities. Now, I suppose it could be avoided if a shareholder renounced his United States citizenship and emigrated from the United States, but we incline to think that that is a less responsive margin of choice than the location, the booking of corporate profits, or the location of corporate investment, or the chartering decisions of corporations.
Let's talk a little bit about the pass-through part of this plan, because it's actually not a 15% corporate rate in the one-page summary. They say it's a 15% business tax rate. And at the press conference announcing it and at the event on the Hill, Treasury Secretary Stephen Mnuchin explained they're looking to give a 15% rate to pass-throughs, or maybe just small business pass-throughs, or maybe just some pass-throughs. It's not very clear. What is the effect of extending this 15% rate to pass-throughs? Is this going to just increase shelter opportunities? Is there a way to limit this to just small businesses? Is this just a political, a way to get political will behind this by not getting the small business community and the pass-through community as immediate opponents? I mean, what do people think? Marty?
Well, the necessity of appeasing small business is absolute, so there's going to be no corporate relief without commensurate relief for small businesses and pass-throughs. Will there be tax sheltering opportunities? They'll be massive. With the differential being, 15 versus 33?
Yeah,
35. And with no, people have been trying, as I understand it, I'm not expert in this area, but people have been trying to figure out the difference between salaries and profits in small businesses for decades, and they've come upon this 20-point test, which doesn't sound very easy to administer. And that's now only applicable for the area of conflict is whether employment taxes apply or not. With this 20% differential, the pressure will be enormous. And just look to Kansas as a case study, and the Kansas top rate is only 5%. But I've been told there's massive incorporation of self-employed individuals.
Under this system, it is clear to me that the dean and I will have a conversation about how the law school is now hiring a Ty Grinberg LLC, and that is clear.
Yeah. And that's what everybody should do if this happened.
And Kansas, the highest paid state employee is Bill Self, who coaches the Jayhawks basketball team. And I think he actually had an LLC before they exempted self-employment income. But after that, he negotiated a new contract and said, I'd actually like most of my compensation to go into the LLC. So he actually pays a lower effective tax rate than a philosophy professor, somebody who doesn't make very much money. And, there are lots of great examples of people going to great lengths to avoid just the 2.9% Medicare tax. There was the example of John Edwards and Newt Gingrich, one previous presidential campaign, where it was discovered that, even though they had millions of dollars of income, most of it wasn't compensation. It was just other stuff. It was a nice op-ed by Fred Goldberg and I think it was Michael Gratz in the Washington Post, where they looked at Donald Trump's financial disclosures and discovered that in, I think it was 2015 or maybe 2014, he reported $14,000 of earnings. This was a year in which he was in charge of a multi-billion-dollar multinational corporation. He had a very successful franchise on his reality television program, and apparently none of that was actually compensation for his employment services. If he actually reported that on his income tax returns, which of course we have no way of knowing, that would have avoided or potentially evaded millions of dollars of taxes. Yeah. We had this event at the Tax Policy Center where representatives from the Trump campaign came, and in the same event, they complained that we didn't give them credit for slashing regulations as a boost to economic growth. And then Wilbur Ross, who's now the Commerce Secretary, but was representing the campaign on tax policy, said Treasury lawyers could easily write regulations that would prevent any of this kind of gaming. So it turns out that there's only one agency in which regulators are omniscient. I'm sure everybody at Treasury is really proud, but maybe a little skeptical.
The proposed solution, one proposed solution is a mechanical solution where we just assume 70% is wages or something. Just having thought about that for about 30 seconds, that just seems like just changing the effective rate from 15 to 18%. That it really doesn't change anything. Right. So that's after that, there's no bright line approach. It's just a facts and circumstances approach. And where every, in this economy, it'd be 50 million, at least 50, 60, 70 million people who would be looking at this.
Yeah, I mean, look, you can solve this. You have to have a distribution tax on partnership income, right? So fine. We can maintain any rate we want inside the business entity as long as we say there's another level of tax when you try to take, cash out of the business entity. And we'd have to figure out how to make that work. We could do that. That's the solution.
So basically, tax pass-throughs the same as corporations. It's typically you think about dealing with double taxation by taxing corporations like pass-throughs, and they're going to go the other way.
Right, you go the other way.
Well, they are getting a 15% rate out of it. I mean, So what would the ideal solution to the pass-through problem be then? If the problem is a massive rate differential between the individual and the corporate side, in this plan it's 35 and 15, but even in other plans it's still going to be something in the 30s to something 20 to 25. But we acknowledge that we can't proceed on business tax reform without dealing with pass-throughs. What do you do? I mean, how do you appease pass-throughs without creating this leakage in the system, this this incentive to shelter income in pass-through form?
Well, how do we politically appease them? There's no way to politically appease them unless you give them a lower rate. But what I would suggest as better policy is to provide other tax incentives that are not tied to the rate, perhaps tying them to certainly expensing, but perhaps a wage credit for small businesses who actually, remember, many small corporations and businesses are not employing any. In fact, most of them are not employing anybody at all. So when we talk about this being an important incentive for job creation, look at why don't we tie it directly to small business job creation with some sort of wage credit for small business. But that will, even if you spent more money on a wage credit, I don't think that would politically appease the small business community. They want a lower rate.
Yeah, I think the politics are very challenging, but policy-wise, one of the better solutions is something that Alan has suggested, which is corporate integration so all income across the board is just taxed at the same rate, regardless of what type of entity you put in. Of course, the timing and how the tax works, I think, is going to differ, but you're still going to face even rates. I mean, it's hard to convince pass-through businesses that there are 2 layers of tax for corporations, but
There are.
Yeah, but I think that's policy-wise, that's the direction you have to go in.
Let's talk a little bit about corporate integration for a second then, because one of the main competing plans to the Trump plan and to the House blueprint has been a corporate integration plan that has been being worked on by the Senate Finance Committee for a long time now, since Orrin Hatch basically became the chair. Why is this plan taking so long to come out? What are the difficulties in accomplishing corporate integration that's causing Hatch to continually delay the release of it? Like, why haven't we seen a plan like that?
I think the delay may be more political than just trying to figure out what the proposal is. I mean, I think back to when he was actually about to release it. It was back when President Obama was still there, and I think everyone was expecting divided government after the next election. So he was thinking that this revenue neutral, distributionally neutral tax plan that I'm going to release is going to be a feasible tax reform plan. So I think that's the delay there. I think corporate integration would be a very good idea. I also think that it's moving in the same direction as the destination-based cash flow tax economically. What you're doing is shifting your tax burden onto your domestic shareholders. That's a good thing. They're not as mobile. It does it in a different way. It still faces some challenges. I believe the Hatch proposal may face some issues on treaties and how their withholding taxes may treat cross-border transactions. But economically, I think it's a good direction to go in.
Does anyone else have any thoughts on the corporate integration, or?
I mean, I would just agree with
Kyle, although I hate to prognosticate politically, that, we are learning a lesson about how you may want to hold back good, plausible ideas until implausible ideas have been shot down. So maybe Kyle's right.
Economists have been enamored of the idea of integration for forever. I mean, certainly since the Harburger model, late 1950s, which sort of showed that distortion between corporate and non-corporate businesses and the effect on resource allocation. It's never been something the public or even businesses get all that excited about. And part of the problem is that, most people don't understand economics, and it's really hard to explain, at least for economists and lawyers.
Right, but I mean, the interesting point is that the other problem, which is also the problem for expensing, is a financial statement problem. So there are lots of people who believe that the economics or the sort of the cash flow consequences aren't what drives the behavior of publicly traded companies. Instead, they think that financial statement sort of results drive that. Now, query whether that's really true in a fundamental reform of the scale of the DBCFT. I actually have real doubts about that. Like, if you fundamentally change the system, do the financial accounting rules not change? People not understand what temporary differences mean in this system where you have massive temporary differences, but there's this distinction between temporary differences and permanent differences in financial statements that makes a huge difference to people sitting in the CFO's office. And the reality is that that is how the Hatch team got to a dividends received deduction approach to integration. They basically figured out that that produces a permanent difference for financial statement purposes that therefore financial analysts will take into account, whereas traditional models of imputation that I used to think were a great idea don't get you there. And so, we haven't had that debate yet, and that discussion hasn't percolated, but potentially for the reasons that I described before.
We just need to reform financial accounting, and then we'll be all set.
Possibly. I mean, actually, an interesting question is, if you have tax, people don't think about this. If you have tax reform driven, say, from the Speaker's office, you cannot change the financial accounting rules in the Ways and Means Committee or the Senate Finance Committee. But actually, Congress can mandate that those rules change. Congress can do so. The tax writing committees just can't. If you have leadership from the leadership of Congress as opposed to the leadership of the tax writing committees, you can change the financial accounting rules to fix those problems.
There is the question, I suppose, if Congress does try to change the financial accounting rules, whether they will, in fact, adopt the economic ones or not. We are perhaps, some people would perhaps characterize this as economic imperialism, that we economists think that we can do the financial accounting rules the best. I think I'm an economic imperialist, and so we'll just put that on the table. I think that, the distinction, the permanent versus temporary, is an amazingly pervasive concept when people talk about accounting, and it really does, I think, distort a lot of the understanding of what the policy options are. And so there probably does need to be more attention paid to the question of how the accounting rules are affecting the debate and what different changes in the accounting rules might do to improve the debate.
But politically, I think the accounting rules, because members are more inclined to listen to CEOs than economists, when push comes to shove, they will, what matters most to CEOs and CFOs is their effective tax rate, and that's what motivates them, certainly politically. We've seen it over and over again when they've asked to redesign provisions that are economically equivalent in order to get the better accounting treatment. So that's one reason why I think of all of the big revenue raisers that are on the table, I think expensing, which does not lower your effective tax rate, is the most vulnerable, even though we economists, because it reduces another effective tax rate, which is entirely different, the marginal effective tax rate, we favor that. But I think expensing is most likely on the chopping block, because when you talk to, at least when I talk to business folks, one fellow said to me the other day, because I don't know what the constituency is for expensing, and I said it's just the economists, and
A powerful voting.
a very powerful.
I mean, the most common rejoinder when you talk about expensing and the interest deduction is to say, but the expensing, is a timing difference, and then the loss of the interest deduction would be a permanent difference. And, well, of course, the expensing is of real value as long as nominal interest rates are positive. And of course, if nominal interest rates are zero, then the interest deduction, would be irrelevant. So, but nevertheless, there's this distinction between the permanent and the temporary. I think Marty's right about the vulnerability of expensing. The fact that it's not mentioned in the Trump outline is, I think, a signal of that.
It's never been a big priority for Trump, right? In his original plan, didn't he? Or maybe it was his second plan. He allowed you to pick between expensing and the interest deduction.
That was the one, or one of the larger changes between the September 2015 and October 2016 plans. Is this choice? Of course, you should just pick a system, cash flow or not, and stick with it. But he decided to split halfway in between.
But one big difference, Mr. Camp reduced the depreciation. Mr. Brady, his successor, is very much in favor of expensing. So, but I think he might have to change his mind on that point when push comes to shove.
I mean, it's important to recognize that you have very different incentives if you're talking about publicly traded companies and other businesses. So I think it is true that other businesses care about cash.
Mm-hmm. Yes.
Care a lot about cash.
Yes.
And that tension pervades tax reform. And to speak in the current chairman's sort of behalf defense, I think he comes from a Main Street environment. And so it makes sense to him to think about cash.
I think they would definitely retain it for small businesses and even raise the definition of small businesses for expensing. It does make economic sense because small businesses have difficulty getting loans and need cash flow, and the economics back that up and the politics back that up. So I think the small business expensing, even expanded to medium-sized businesses, but to give Apple expensing, it just doesn't make any sense at all economically or politically.
I mean, Section 179 does seem to be very popular, and so it does indicate that, small business expensing does seem to have a constituency, but not the big business expensing, perhaps.
Let's talk very briefly, because I think we've hit a little bit about most of this, about some of the individual changes. The eliminating most deductions except for home ownership and charitable, repealing the alternative minimum tax, repealing the estate and gift tax, and then eliminating targeted tax breaks that mainly benefit the wealthiest taxpayers, again, not specified. I mean, what do people think is a pathway for individual reform? Would this dramatically change the individual tax system, or are these just tweaks around the edges? How feasible are these?
Well, just to give some points of reference, when you double the standard deduction, I think, about 25% of Americans itemize, and then I think it would rise to or shrink to 5%. Yeah. So the mortgage, even though you keep the mortgage interest deduction on paper, the reality it would only apply to a much smaller population. And then you cut the state and local tax deduction, and the mortgage and housing construction industries are, adamant against it. So I think it's pretty tough on that count.
We have a very different individual income tax system today than we did before the Tax Reform Act of 1986. That's the point Marty made earlier, I guess, about maybe both parts of the tax system. But on the individual side, I think that this unthinking, reflexive support for base broadening does need to be questioned. Obviously, there are provisions in the individual income tax that do offer distortionary preferences for particular activities. Owner-occupied housing obviously does receive a substantial subsidy, and an unwarranted one, even if you believe that the government should encourage home ownership.
Right.
The current preferences for owner-occupied housing are not well targeted to moving people over from renting to home ownership. Instead, they're more oriented towards increasing the cost and size of homes for people who already own homes and already own relatively large homes. So yes, there is constructive base broadening that could be done, although in many instances that may be the base broadening that's the hardest to do. But if you even just look at itemized deductions, I mean, the deduction for investment interest expense makes good sense in a income tax where investment income is being taxed. A deduction for employee business expenses certainly has a conceptually valid role and certainly some legitimate application, although one certainly could question some of the features of what is a deductible employee business expense. The question of whether people ought to be able to deduct large medical costs and large theft and casualty losses, I mean, there are some interesting debates about that, but it's hard to see those deductions as really being inappropriate. There are large tax breaks for retirement saving, to be sure. If you start from a premise that, consumption taxation really might be better than income taxation, then, those are not necessarily inappropriate either, although, in a world where other types of saving are being taxed. I mean, there are a lot of difficult questions. I do think, though, that we should beware of the notion that getting rid of a deduction or a credit is and offset and then offering a lower statutory rate is always a good thing. That depends on the provision.
Yeah, it can't be true. It cannot be true. It just turns out that is a default rule because we assume that people will put in provisions.
It's not the worst default rule.
Right. It's not the worst default rule
but it is
ever.
A default rule.
But it's got to be incorrect in all cases. Yeah.
I mean, and actually, just another note of something that the Trump outline talks about. I mean, childcare costs, I think, clearly are work-related costs that should receive tax relief as a cost of earning income. The economic definition of a work-related cost is something that when you make it less expensive, you get an increase in labor supply. And there's just an extensive literature on labor economics demonstrating that when childcare is cheaper, that there are more parents working. And so, I mean, in some ways, maybe it's an elaborate proof of the obvious, but it's a successful proof because the studies show this. And so it tells us that childcare is a work-related cost and should get tax relief. Some base broadening plans would scrap tax relief for childcare costs. And again, it's just an example of a reflexive attitude. The base broadening must always be good.
But importantly, you can't just do it as like a deduction because for whom does it matter? Presumably, it matters at the low end. I mean, or query.
Well, or it probably is more significant there, yes, that's right. And so the question of the design of the incentive poses some significant issues, as is always true.
So I've always thought it'd be good to get rid of the alternative minimum tax. It just seems like an affront to the whole idea of a sensible tax system where you go through your tax calculation one way, calculate tax liability, and then if you're paying attention or you use software, you find out you've got to calculate your tax under a completely different set of rules and see whether your tax is higher or lower under that one. There's been attention to the AMT because the tax return that was leaked for Donald Trump showed that were it not for the AMT, he would have paid almost nothing in taxes. The right answer is not to say, well, we should keep the AMT because it makes people like Donald Trump pay taxes. The right answer is actually look at whether what is Donald Trump's income? What is, what, of course we'll never know, but to look at the tax, the things that actually are tax shelters that keep wealthy people from avoiding tax even though they have lots of income before deductions, and to include, basically to get rid of those tax breaks in the regular income tax. Of course, that's all in the list of the unspecified loophole closers, but that's really important, and it's actually probably a good trade. The other thing that it hasn't been talked about, although I guess Alan alluded to it indirectly, is that it's not just things that show up on a Schedule A, itemized deductions, but some of the biggest tax breaks in the code are exclusions. And the biggest one is exclusion for employer-sponsored health insurance. And just like the home mortgage interest deduction, most of the benefits go to higher income people who don't need it, and it's probably even counterproductive to the extent that it encourages people to get more expensive health insurance at work. There's this, sometime in the future, the Cadillac tax will kick in, and it'll effectively limit the exclusion. this will come actually at the same moment as the magic unicorn arrives.
Yeah, right.
So it would make sense to actually think about, to think about the role of the exclusion and think about whether it makes sense to do something that's more targeted to helping people pay for healthcare, maybe in the context of an overhaul of the Affordable Care Act, if you actually think that coverage is an important objective.
Right. I mean, one thing to recognize, right, is if you got rid of the exclusion for employer-provided healthcare, you would go a long way towards converting the U.S. healthcare system into the Swiss healthcare system. The Swiss healthcare system actually works reasonably well. So.
But you would have to have tax credits for people who get insurance at work, low-income people in particular.
Yeah.
And the exclusion doesn't really do that. The exclusion is most valuable to people earning a lot of money.
Right. No, I was saying current law. So ACA.
I was agreeing with you.
Yeah.
So before we move on to audience questions, assuming there are audience questions, just a question for everybody, and we'll go down the line just like we did at the beginning. Just very briefly say, what's next? What do you see happening next? What are the prospects for tax reform? If not this year, in the near future, what are the prospects for the administration's plan? If you want to talk about the House plan, that's fine. Just sort of, what do you think is the next step, like the next development? Itai?
I don't know. I don't think this plan is changing anything. I feel bad for. I mean, you could listen to the acting assistant secretary for tax policy talk about his daily meetings with the secretary and their work on a proposal literally a couple days, maybe one day, before the president announced at the Treasury that they would release tax plan the week after, and you would have had no sense that they were about to release a plan. And so I feel bad for people who may have done lots of work on something else. And that's all I have to say.
I mean, I'm afraid that what's going to come out of this is a tax cut that's not tax reform and doesn't deal with any of the fundamental problems with our tax system and makes our fiscal problems even worse. I'll put my Pollyanna hat back on and say that there are some good things that came out of this process, and that is that you've got people thinking about things that really would be reformed. The process in the House and in the Senate, Ron Wyden has spent decades thinking about ways to craft bipartisan tax reform. And if you look back to the Tax Reform Act of '86, it wasn't just Ronald Reagan woke up and said, hey, we're going to have a tax reform. There have been people working for a long time on ideas and blueprints. There actually was something called blueprints for basic tax reform. And people putting out ideas that seemed politically infeasible at the time, but setting the groundwork. And there will be a time that we have a president who cares about this, wants to assert, wants to and is willing to assert leadership, has political capital to spend on it. And the ideas, not the ones on the one-page set of bullets, but the ideas that are being discussed both in Congress and things like the total yard proposal and other proposals are out there, are setting the groundwork for the Tax Reform Act of 2027.
So I'm not a political forecaster. I mean, I think it's difficult for economists to predict these things, but I guess my outlook is probably similar to Lynn's. I think that there may or may not be a tax package adopted in late 2017 or early 2018. If it is adopted, I think it will be a tax cut, and actually might look like a watered-down version of the Trump outline. That is to say, there will be a corporate rate cut, but not down to 15. There will be individual rate cuts, maybe more or less along the lines of what's in the outline, and some other goodies. There might be a little bit of base broadening, but not very much, and certainly not enough to make it revenue neutral. Longer term, though, I think, as Lynn indicated, there just will be pressure to actually move to a better tax system. It may end up happening during a real or perceived crisis. Perhaps it will happen in a moment of bipartisan agreement in advance of crisis. It probably won't happen in the near future. But I think when it does occur, it is likely to involve some type of move towards shareholder taxation or a move towards a value-added tax or close cousin thereof, or possibly a combination of both. I mean, there could also be a carbon tax in the mix. So we will have to wait and see what the future holds.
I think that the Trump administration put this out as a wish list. I think they wanted to avoid a lot of the tough choices that a lot of the tough political issues that they saw with the blueprint. But I think eventually they'll learn, or hopefully they'll learn, that just none of this is easy. So even if, and this will be just my one comment, even if you just go with a pure tax cut, I think there are still trade-offs and limits to what you can do. If you think of the Republican coalition, it's not just one block of Republicans that agree on absolutely everything that they want to be in the tax code. There's going to be those that want to spend most of their revenue on a corporate tax cut. Some of them are going to want to maybe do some base broadening or some base changes that are good, but on net may lose revenue. There are other Republicans that want to see expanded child care provisions or just child credits in general. All of those things are going to cost revenue. All of them are going to compete against one another. So I think at the end of the day, this is going to be hard no matter what. And I think the Trump administration will realize that, and that you can't avoid tough decisions here.
I agree with mostly everything that's been said so far. I'll just make a few elaborating points. One is, I think there's no possibility of business-only tax reform for political reasons. My assessment is that as much as I would like to pursue it further, the destination-based cash flow tax is probably not viable. As much as I'd like to see that happen. I think the long-term, all roads lead to that, but I don't know how long the long term is. In the intermediate term, I don't think there's any possibility of tax reform in this calendar year. And I do think that if there is tax reform in 2018, as Alan said, it will be some scaled down version of the Trump reform with a lot of very complex gimmicks claiming it is revenue neutral that most normal human beings cannot understand. But one thing I do worry about is that if the tax cut is too small, the political support for it will die. So, for example, if the tax cut, the corporate rate is 28%, and people go, well, that's not low enough, let's do more. And there's too much base broadening. So I think once the dam breaks on deficit neutrality, real deficit neutrality, I fear that it might be a big dam break. And then where does that lead us? That leads us kind of back to 1981, where we'll be set up for larger deficits, and then a second round of whatever that will be is going to be very interesting. Remember, everybody talks about, we haven't mentioned it here, the Byrd rule, and it certainly would have to be only a 10-year or maybe even less. You have to remember that the Republicans themselves might have a tax increase if we have a repeat of 1981, if the deficits get too large. And also, there is a possibility within the next 10 years the Democrats come back into power. So whatever happens is probably going to be impermanent. It's not going to stay the same.
Yeah, I mean, it is worth saying, this notion that there's a 10-year cut. I mean, everything is possible. I mean, I can write a provision that includes tax that raises a lot of revenue beginning in the 10th year and that will never come into effect, and I can avoid the Byrd rule. I mean,
the Cadillac tax, you mean?
Yeah, like the Cadillac tax, exactly. The pot at the end of the golden pot at the end of the rainbow. I mean, I think. Anyway, these are unrelated thoughts, but Fred Goldberg used to say, we all know how the movie ends. It ends with a vat. We just don't know when the movie ends.
It's also important to point out that this is not 1981. In 81, even though it seemed like we had big deficit problems, that the debt was 33% of GDP, it's now 77. The baby boomers were entering their peak earning years where they're going to be earning lots of money, paying lots of taxes. We're retiring now, we're drawing on the system, we're just going to draw more and more Medicare, Medicaid, and Social Security. And there are reasons to think the economy isn't going to be producing as much economic growth beyond the labor force participation issues as it was primed to do in the 80s. So the problems are a lot more serious, and it'd be good if politicians actually recognize that, and if they could explain to the American public that magic unicorns don't exist, and we need to take this seriously before we screw over our kids.
But I agree with that 1,000%. But just one interesting observation: in 2012, Mitt Romney ran for president, and he was dedicated to revenue neutral tax reform. All of the Republican candidates in 2016, none of them were vowed to deficit neutral reform. In fact, they all proposed huge revenue losers. So I think, unfortunately, Len, we're heading in the opposite direction where there's less concern about the deficit rather than more, even though the concerns are greater now, far greater now than they were in 1981.
It's a little ironic, or maybe not, that the winner turned out to be the reality television star who was the biggest loser on tax reform.
We have a few minutes left. If there are audience questions. In the back.
Yeah, I have a question about dynamic scoring and whether there's any lessons learned from Kansas in terms of like how people are building their models and understanding the way huge Laffer style tax cuts might impact revenue down through the long term.
I mean, the problem with Kansas is it's kind of a dumb tax cut, and it's not just a test of the proposition of what the effects of tax rates are on business activity or economic activity generally. It's creating a big wedge between basically an exemption for people who call themselves self-employed. And the fact, it's still relatively early to assess what happened, but Kansas has lost a lot of revenue. Its economy has lagged behind that of nearby states. There's certainly there's no evidence that tax reform was a plus for the economy overall. So it's the lesson you get is that you should be cautious about big differences between tax rate, particularly on pass-through businesses, and on ordinary income. Bigger issue, and it's an issue that has been a subject of contention in the economics profession for a long time, is how much individuals and businesses respond to taxation. One of the big questions is how much you gain from having a more neutral tax system that taxes different kinds of activities in the same way. Most economists, probably all economists, think that's a good thing, but it's not entirely clear how much that translates into more economic activity. I don't even think we have a really good sense as to what the unfortunate incentives for international activity are costing in terms of real economic activity in the United States. A lot of what companies do to avoid U.S. taxes, multinational companies do to avoid U.S. taxes, is arranging financial transactions in ways to avoid U.S. tax liability. It's not clear how much, whether that kills a lot of jobs or whether it's mostly just accounting.
I think there are two lessons from the Kansas experience. One is the pass-through issue, that it's just a poorly structured tax plan, and I don't think I think the Kansas proposal was just a very large tax cut. I wouldn't even call it a tax reform proposal. That brings me to my second point, is that if you're going to cut taxes, just expect that you're going to lose revenue. You may at the margin grow your economy depending on what you're doing in your tax reform proposal, but you're not going to bring revenue back to where it was.
Yeah, I have one other depressing lesson from Kansas. So the Republican chairman of the Kansas Senate Finance Committee at the time was a pretty good friend of mine. And he said that this pass-through thing wouldn't work. And he understood that you might lose revenue and that there would be gaming. And he tried to make those points and oppose the process. And as a result, he lost the political battle and lost his seat. So the right answers don't always win the day.
It's ironic that the Kansas experience in some ways actually illustrates the power of incentives and the importance of getting incentives right. You give people an incentive, to convert wages to pass through income, and lo and behold, they convert wages to pass through income. And I think one of the important reasons that we want to incorporate incentive effects into revenue estimates, and it's true to the extent that we can do it for both the microeconomic incentive effects as are applicable there, and also the macroeconomic effects, is not so much to make tax cuts, easier in general. Perhaps it will to some extent if we realize that some tax cuts have beneficial incentive effects. The main purpose is to really try to distinguish the good tax cuts, the ones that are sensibly designed, from the ones that, I guess to quote someone here, the dumb tax cuts. And so I think we've seen an example of how that plays out in that particular state.
Maybe one more question, Ajay?
Yeah, so I think there was almost unanimous consensus on the panel about the VAT, or the future of an American VAT. And I'm always reminded of Larry Summers' comment. He put a full one about liberals are against it because it's progressive and conservatives are against it because it's a money machine and it won't happen in this country until we flip. What are the chances that flip's going to happen? Or how does it happen?
I mean, I agree with Alan that if we get to the crisis point, that could be the time where we're looking for a source of revenue that doesn't hurt what might already be a weak economy. And a VAT would be a good candidate. Hopefully we would get there before the crisis point. One of the interesting things, Alan, were you and Bob Carroll the ones who made the point about how in 81 there was a sense of the Senate resolution that said we will never ever cut benefits for Social Security.
You would never subject social. Some people say the VAT just is politically unviable because in 2010 the Senate passed the Sense of the Senate resolution 85-13 saying we should not do a VAT. And so I've always argued that you really have to discount that type of resolution in wake of previous experience. In 1981, the Senate of the Senate resolution 98-0, stating that Social Security benefits should not be subjected to individual income tax. They should remain exempt. So, of course, that was in July of 81. It took less than 2 years, of course, before the Social Security compromise legislation was adopted in 1983, which did subject a portion of Social Security benefits to income taxation. And of course, in the 1993 legislation, we increased that still further. So, if a 98-0 resolution could break down in 2 years, the possibility of an 85-13 resolution breaking down at some point in the future certainly has to be allowed for. The general point, of course, is, the VAT and taxing Social Security benefits both fall in the same broad category, which is these are things that nobody is clamoring for, and they're not going to happen because people step forward and say, we're really excited to do this. In both cases, these are things that happen as a compromise when you decide that the alternatives are worse. And so in 1983, the decision was made, we've got to do something to prevent the insolvency of the Social Security Trust Fund. And this is a tolerable option as part of a broad package that we wouldn't have actually been enthusiastic about in isolation. I think you would see the VAT eventually happening in a similar context.
Yeah, one thing I guess the last point I'd make on this is, so the House Republican blueprint is definitely not a VAT. But 2 Republican candidates for president proposed VATs. Now, they both strenuously disagreed that what they proposed was a VAT, but, you can call it what you want. You can give it a different name. They were VATs.
It's not just Ted Cruz and Rand Paul, but actually Herman Cain 4 years before.
Yeah, right.
It's really 3.
Marco Rubio proposed the next tax, which is
Paul Ryan proposed a VAT in 2011.
Yeah, as part of his first version of the roadmap plan. So
he got off that road pretty quickly.
But somehow you've got to get at least one of them to admit that
it actually is
a VAT.
Well, Mr. Cardin on the Finance Committee and Senator Cardin and Mr. Renacci Republican of Ohio have proposed value-added taxes. So there's a foothold on the beach, but it's a long way to go. And I think it's got to be a particular type of crisis too, because if 2008 wasn't a crisis, I don't know what was. I think it's probably be tied to Social Security and Medicare.
It's possible the bipartisan agreement could occur without a crisis, but, reporters often ask me, like, when might that happen? And my answer is always that that kind of bipartisan cooperation never happens except when it does. And I think, you look back at 1986, even in retrospect, it's hard to understand why there was a bipartisan agreement and why that tax reform emerged. There were so many random factors along the way that rescued what seemed, the package from what seemed to be certain death. And so if you can't explain these things in retrospect, trying to predict them is certainly an unduly ambitious undertaking.
I think that'll have to be the last point because we've come to the end of the time. I want to once again thank our panel for participating, particularly on short notice, and providing such a wonderful discussion. I want to again thank Georgetown, along with Mr. Ellis Duncan, for getting us the room and helping with the organization, and thanking the audience, both here and online. Thank you, everyone, for participating, and have a good day.
Thank you, everyone.
This is a good discussion. Oh, I think we could.
That's the philosopher take from the show. Then
Yes,
everything will work out.
Yeah, we're all eager to put ourselves forward as the philosopher.
Yeah, right. Yeah, right. Let me shake the people who. Kyle, you and I have never met in person, so I feel like I should shake your hand.
Oh.
Yeah, I'm sorry, I'm blocking everyone's way.
Yeah, my colleague, I think my colleague Scott Greenberg had met you at one point. He actually introduced me to your argument about how you can make the DBCFT WTO compliant, which is turn the deduction into a credit.
Yeah, I have actually another answer now.
Oh, you have another one?
Oh yeah, I have another answer.
Is it even better?
It requires fewer changes. Hey, thank you for coming. I'm excited that you came. That was great.
Smart people.
Oh, whatever. Yeah, we decided to talk. You know all this stuff. We didn't say anything. I mean,
Although it's more, I just don't think last week was catered to this audience. The 97th day, it doesn't, but I think it really depressed people.
I mean, are you telling me if I'm wrong?
I just don't think it counts. So yeah, I was going to take my forecast of, I've been fairly consistent at 30% of since the election. In the 25th.
Yeah.
And I put it on a watch, so the ratings watch.
You actually have this thing? Like you have it in your own head, or like you have like something that you like clients.
I talk on this topic daily. Right. And people always want to know, what do you think wins? So I have my, it's on November 9th, I said it was like 30%. People are like, you're crazy, you're way too low, right? And then it becomes April, and I'm like, I'm at 30%.